Hello and welcome to the first of these interviews as part of the Sustainable Finance Masterclass. So it's with tremendous pleasure that I introduce Mark Campanale. Mark, I think it's fair to say, is probably one of the legends of the sustainable finance industry, having worked in the very early investment funds that first promoted responsible investing, or ethical investing as it was known back in the 80s and 90s. His career spans a number of the major investment companies in the UK, and he's had a tremendous influence and shaped that industry, I think it's fair to say. Now Mark's focus is much more on policy, I think it'd be reasonable to say, and the development of his not-for-profit organisation, which is Carbon Tracker. So Mark and I are just going to talk through some of the history and the background to sustainable finance. So perhaps we could start there, Mark. So what brought you into sustainable finance and thinking about how the investment industry could have an impact, a positive impact on the world?
So if you knew me in the 80s, I'd trained as an agricultural economist. I thought I was going to be working development aid finance. I went through, I worked for some advisors who supported the Band-Aid Live Aid group. Do you remember?
Of course,
Bob Geldof,
1985-86.
Yeah. And I was all set up to go into that space. And in fact, I worked out for a while in East Africa, West Africa. And I thought, well, to change the world is and the world around us, I would work on aid projects. Life didn't turn out to do that. Sure. I ended up coming back for various reasons, but what struck me is that you could either solve the world's challenges through philanthropy. We need to do that, certainly for a lot of things, but actually the other way to change it is through things like fair trade, sustainable finance, bringing capital from the north to the south. And the last project I worked with in Tanzania was with something called the African Coffee Company, which supported and became part of Cafe Direct.
Of course, I remember Cafe Direct. Yeah, one of the early fair trade businesses.
I was involved in trading fair trade coffee, not too far from here actually, in East Cheap for the Schluter family. So that was how I got started. And when I got back, I fell in with some folks who said, look, we're setting up a green fund in the City of London. There's space for an analyst. Do you want to come and join us? I wasn't going to say no to that offer because I wasn't sure, what the world was going to.
And that would have been the late 80s?
So the conversation started in 1988. So the Jupiter Ecology Fund was launched. It was then called the Merlin Ecology Fund in 1988. I essentially joined that team in February 1989. So this is my 35th year.
Wow, incredible.
In green and ethical finance.
Right, okay. And what were the challenges getting a fund like that started at the time? I mean, that was a time when really, the challenge was getting people to accept the idea of an ethical or sustainability, and no one really spoke about sustainable finance.
Well, we called it a green fund, and it was important that people could see it did what it said on the tin. And so the first adverts and the first newspaper coverage were about the solutions, the businesses that we were going to invest in. Yeah. And just focusing on the stories. So the original advertisements really were talking about the stories of this sustainability, the challenges of building a new clean energy system, of recycling, of energy conservation, of sustainable forestry. So very positive. And it was led by this remarkable woman, sadly no longer with us, called Tessa Tennant. And had built this great team, very inspirational, a lot of financially. Some of the best times of my life working in finance were working with that original gang. Okay.
Were you influenced, do you think, by some of what was starting to happen internationally through the Kyoto Protocol, the Brundtland Report?
Yeah, the first literature did talk about the Brundtland Report from 1987. And then to talk about the Earth Summit Treaty, particularly of 1992. And one of the first things that I got involved in with some great collaborators, one of which I still work with, Nick Robbins, was a book called Changing Course that went into the 1992 Earth Summit from what was then called the Business Council for Sustainable Development, and its follow-up called Financing Changing Course, which really centered sustainable finance, green finance, as part of the solution to bringing a more sustainable world. And I mean, you asked me earlier what got me into this, and I mean the sort of the saying about if you want to change capitalism, the first thing you've got to do is take control of the capital.
Okay, yeah.
So I thought, well, look, the idea of building a fund or building a series of funds where we could raise hundreds of millions to invest in some of these sustainability solutions, that was the way you're going to change society. That was going to be the way you change capitalism. So challenging corporations to bring them to account on one side, but the bit that really got me was finding the companies. And these were the days when in a fund, you can't do it now, John, you probably could get hit by compliance, is you could have a public fund that invested in private companies. And so then we invested in this technology company called Fuel Cell that was removing emissions from the flue stacks of polluting industries. And we're invested. One of the two first deals I remember was one was called a company called Waste Recycling PLC. It was worth 10 million.
So that's very small.
And we invested $1 million.
Right.
You can't do that now because it's microcap. But it became a £1 billion company. It ended up being sold to Terra Firma when Guy Hands bought it a decade later. So investing in really game-changing companies. And we did our first renewable energy deal 30 years ago in California. It was a company called California Energy doing geothermal energy. Right. So we were finding great companies, really interesting, and investing in some private sort of startups and early stage businesses, a lot of which compliance would tell you can't do.
Yeah. So it's fair to say there'd be considerabbly higher levels of risk on that type of thing.
That was true, but it was part of a bigger portfolio. But it was the point I'm making is that there was a lot of freedom to invest innovatively, to invest in great companies, great people, and we weren't sort of sitting around with sort of twiddling our thumbs trying to work out whether something kind of, I don't know, ticking dozens and dozens of boxes. Right, that was important in due course. But no, it was about the inspiration of the entrepreneur.
Right, okay. And to give us some idea of scale, so that was the Merlin Fund, Jupiter.
Yeah, Merlin became Jupiter.
That became Jupiter Ecology.
That's right. Yes, okay. And then we launched one of the first green investment trusts. About 30 years ago. And we also invested in our first maybe it was a few years later when I moved on from Jupiter, but our first private equity fund involved in clean technology as well. Right, okay.
And then you moved to Henderson and were involved with the Industries of the Future funds at Henderson.
So what happened afterwards was that the four of us, it would have been Claire Brooke, who now runs the Blue Marine Foundation, myself, Tessa, and Anne-Marie O'Connor, who leads sustainability for the New Zealand Government Superannuation Fund. So you had people doing great things after we moved on. We went on to a business called NPI, which was the National Provident Institution, not too far from where we're filming today. It was a Quaker-based life company, and they allowed us to launch a whole new range of funds, build a whole new platform called the Global Care Funds. Within 4 years, we'd gone from 10 million to $1 billion, and then to 2 billion maybe within 6-7 years. And we had the institutional backing, and we had the great support of people that, I look back on fondly, like Laurie Edmonds, who sort of saw the opportunity, who was sort of one of the leaders at NPI and allowed us to sort of flourish and do our thing. And we succeeded in winning institutional money.
So institutional money would mean pensions,
big pension funds, charities, and I don't think it's a secret, but we ended up winning accounts like the Tudor Trust, the Joseph Rowntree Charitable Trust, and local government funds from Nottinghamshire and Lancashire. And we started winning all kinds of awards for performance and for the integrity of the sustainability process. But look, great investment team, but through all of that was a clear undercurrent that we're trying to change capital markets, make them more sustainable. So some interesting advocacy, but within the world of finance.
Okay, very good. Okay. So talk to me about the kind of culture and what was happening at that period in the growth of sustainable finance. So was engagement part of the process then? Were you engaging with companies, or was it really sourcing companies?
So it was both. So there were two agendas that emerged really, and I'm talking sort of 94 to 99. So, some time ago now. The first was which companies would form part of a sustainable future. We called them the industries of the future. So where could you find them? And this we created as a clear investment theme. So what we call these industries of the future would be involved in the circular economy, healthy living, areas around education, but also technology, sort of the growth of the internet and learning through the internet and e-commerce. So it was all about what a future could look like, as much as anything. So that was a very clear theme, and I thought we were very, very good at it. And there's funds around today that do that in their own sort of different ways. And then the other was what you would call the corporate responsibility movement, which is how do you make companies more accountable? How do you make them more responsible to their shareholders? And we supported shareholder activism, and I got involved in my first shareholder activism in the early 90s when I brought Surfers Against Sewage to meet the shareholders of Southwest Water, which was then a separately listed company, it's now called Pennon, so that they could present the problems of sewage in the sea. And I ended up becoming a trustee of Surfers Against Sewage. Great group. Now, can't surf to save my life, John, but a great group. And we also campaigned and supported the shareholders' campaign against a company called Fisons, which was mining peat bogs in North Yorkshire, in sites of special scientific interest, and it was a publicly listed company. And so that was about how detailed research on companies, you don't need to do this is another way of doing it, sort of really began to take off. And we sort of, well, the first to in sort of coin phrases like engagement and engagement overlays to talk about how to engage with large companies.
Okay, so bringing things a little bit more up to date, so we've now seen a period where everything we're talking about is part of the mainstream. So we have ESG and this broad concept of responsible investment and impact investing. So what do you make of all of that? What do you think is happening? What are your thoughts about ESG as a concept? Do you think it's effective, or are we seeing a watering down perhaps of some of the principles that brought you into the industry?
It's becoming unnecessarily overly complex, John, to be honest with you. Some simple messages: companies should be accountable to their shareholders and they should do good things. That's been diluted by all kinds of distractions around measurement, which people think that the purpose is the measurement. Actually, the purpose is the outcome. The measurement tells you whether you're producing outcomes, and we've got too obsessed with detailed tick boxing that doesn't actually reveal much at all. And the other part, which is how to ensure that the companies we need to succeed, like renewable energy and sustainable regenerative food systems, how do we make sure that they succeed and grow? And I sometimes feel that we're as far away from that as we were 30 years ago. But the language has definitely grown up, and I'm still in an industry where in London, 35 years ago, I knew the first-hand names of all the analysts working in sustainability, and we all saw each other when we were visiting companies. And today, there was many people working one asset manager doing this as there were in the entire industry in London. So it has grown up. My feeling, though, is that the need to invest in the largest, most liquid companies. Actually, what that's happened is people find a reason for including the world's top 100 companies in their sustainability fund, and so many funds just reflect the market. Right. Okay, and all those innovative, exciting, creative companies, which are often a lot smaller, you have to work really hard to find a fund that invests in those exciting opportunities. And part of that's to do with the way we measure risk and compliance and regulation. And that hasn't actually been, in my view, hasn't been that helpful. Okay.
And your thoughts on the growth of impact investing, or is that possibly the market sector which is addressing that shortage of capital flowing into early stage businesses?
It potentially could do. So I see impact investing. Now, impact investing, I think of it as investing in companies with a clear purpose. They're involved in healthcare in India, they're involved in sustainable agriculture in Africa, or renewable energy, whatever it might be. And that's the main thing that they do, and they probably are privately held. Okay, that's how I understand impact investing. Okay. And then in the public markets, you could take companies doing those things, but are publicly traded, listed. Yeah. But the most important part of it for me is the private markets, and particularly, how I started my conversation with you is all about the global south. How do we move the capital from the global north to where it's needed in the global south? And impact funds private impact funds, many of them are actually doing that. What I don't like is the language where you'll get a large listed fund investing in the top 100 companies saying all investing has impact, therefore all my investing is impact investing, therefore all my investments in the world's 100 largest companies is impact investing. No, that isn't right.
Yeah. So thinking about the retail market then, so obviously we know that a considerable majority of people are concerned about where their money goes. The average person would be interested to know, what happens to their pension fund or what happens to their ISA. But is it realistic for them to feel that they're able to have any real impact through small sums of money? Does the real retail market have a role, do you think, in addressing this?
It really does. There are some companies that wouldn't have come into being. I'm talking right back in the early days. If the sustainable or green investors weren't there to back them, and so no, I absolutely do believe that investors can play a role. But you have to look at the other way. Where would they invest if those choices weren't there? They'll just be investing all kinds of things which are not actually making the world a happy place. And I certainly, through my career and the little modest money that I have invested in the pension, try and invest in the right kinds of companies. And I do spend a fair amount of time thinking about where now I've hit my 60s, I have to start thinking about retiring, John. I still think very hard about where the money goes, and I'm not just the only one. I think lots of people in society that know about this and think hard and try and make the right choices.
Okay. So please tell us a little bit about Carbon Tracker and Carbon Tracker's work.
I will do, but I want to pick up on something which you've not picked up on, which is, do I think responsible investing is addressing the biggest challenges? And all through my career, the last 30 years, and you can ask folks who've known me, the two big issues that I've talked about that I think are important but are largely ignored, and that's probably because the responsible investing movement hasn't got great relationships with the trade unions. Let's be clear about this, which is sad in a way, is I think fair pay and a living wage is the defining and most important issue that companies, if you invest in a company responsibly and you want to be a responsible investor, those companies have got to pay a living wage. And it's amazing how many companies employ people that still have to get support from the state to pay their rent or to pay for certain things, and I don't like that. And I think it's important to pay. And then the other side of it is the large numbers of companies that don't pay their tax. Where they make their money, and even responsible funds invest in those companies. Absolutely. And so who ends up, companies offshore their tax, don't pay their workers.
They're shifting the liabilities onto the state, essentially.
Actually, they're shifting onto taxpayers. They're shifting onto citizens so that people can squirrel money away offshore somewhere or not pay proper salaries so they can pay themselves huge bonuses. And I think we should really have hit that as an issue in the last 20, 30 years, and we haven't. Just to get off my chest.
Of course, it's obviously
Carbon Tracker.
Please.
Okay, so here's the paradox. We've never talked more about climate change as the investment community than we have in the last 10, 15 years. But the financial markets, like the London Stock Exchange, have become more and more carbon intense. Now, what do I mean by that? Is that whilst the UK is responsible for about 1% of global emissions, about 15% of the world's future emissions that comes from the reserves of coal, oil and gas companies are from companies on the London Stock Exchange, the big coal companies, the big oil companies. London is the global financial centre for the fossil fuel industry, along with the New York City or the New York Stock Exchange. And there have been around 2,000 new coal, oil and gas share offerings on the world stock markets, including London, in the last 10 years. Secondary offerings, but a lot of them have been IPOs or initial public offerings. And the bond markets have been fueling the fossil fuel industry through the London markets. And that has intensified. It's not got less, it's got more intense. And so Carbon Tracker, we're a research think tank. We analyse that. We analyse the future business models of these companies like Shell and BP and Exxon
and the smaller companies like Tullow, for example.
We've been looking at those, but none of these companies are aligned with the goals of the Paris Agreement. In fact, they all want to produce. We should be surprised that they all want to produce as much fossil fuels as they possibly can, as quickly as they can, regardless of the consequences for the planet or for the climate. And so our work has been used in two ways. One, by the divestment movement, so all the students working with big universities, and even like University of Cambridge, who we've worked closely with over the years, is moving its money away from banks that fund the fossil fuel industry to different banks and are divesting their assets. Always being used by big pension funds to try and hold companies like Exxon and Chevron to account with varying degrees of success, or trying to support the renewable energy revolution. So Carbon Tracker, we've really been at the heart of that with our analysis, and we're probably best known for coining the phrase the carbon bubble, which is
or stranded assets.
Stranded assets, which are all the coal and oil and gas that the world can't burn, but investors think that they can. But the world can't burn if we're to meet the goals of well below 2 degrees. And my job as working at Carbon Tracker is to try and use regulation and analysis to make sure that we don't tip the planet over the edge into the abyss of climate chaos, but actually we hold back and change regulations and stop these companies from plundering people's pension funds to fuel this climate chaos that we're seeing around in the world around us.
So looking forward, obviously this year we're going to see the launch of the new labels for funds that market based on responsible investment ideas. What do you make of have you looked at the new labelling regime? Do you have any views on that you'd like to share?
I do. It's overly complex, and I still think that finance is difficult for a lot of people, and we're just making it too complex for the average person to understand what all these labels mean. And which is why good informed advice is so important, John. I've always supported the role of the independent advisor, as you know. So I would do it differently, and the way that I would do it, and some people may say that's daft, but this is the way that I would do it, is I would actually create a stock market for green and social enterprises, something called a social stock exchange. I would create those, and all the companies doing these things sustainably, I would get them to list on a separate stock exchange, and then if you're a fund that all you do is invest in companies on that stock market, then you get a tick. You can call yourself a green responsible investment fund. Okay? And make it very, very easy to the qualifying criteria of companies when all the bond market or bonds or equities list on that market. And then your fund then buys shares of companies on that market, and then you market yourself as a fund that backs companies. What we've done is we've created a system where we go, all the companies on the main stock market, any of those can qualify for the Green Ethical Fund, depending on what criteria you choose. Are they transformers? Are they innovative? Are they green? No, I wouldn't do any of that. I think it's so complicated, because you're then trying to use the wisdom of Solomon every day to try and pick between different companies.
So you're talking about the listing rules,
I'm
the
talking
primary rules
I'm talking
that
about
run
the
the
listing rules.
market.
Absolutely. I would have unique listing rules for a social stock exchange where companies had to meet specific goals and objectives around how they treat people, what they make, and so on. And if you got onto the exchange, people would then reasonably assume that you made the cut, and then the investor, whose job is really complicated as it already is, if you're a professional fund manager, they will know that any company on the social stock exchange will have met the criteria, and you can pick them. Doesn't mean that other investors can't buy them for conventional funds, but those funds that market themselves would make it a lot easier. Instead, we've got this horrendous complex, and it takes the fun out of investing, John. That's another reason why I don't like all these labels. Complexity takes all the fun out.
So looking forward then, so from where we are
now... I'm waiting to hear
now...
whether you agree with me, John.
Well, I was on the admissions panel of the Social Stock Exchange.
I still think it's a great idea.
I'd found the admissions panel meetings were always horrendous, Mark, because it was a good hour and a half per company of discussion and debate about whether this qualified.
If you're doing it professionally every day, you know, if you're doing it part-time...
No, you could certainly do it. I think the problem there was trying to... essentially, if you look at the London market, I mean, it's a 300-year-old market that's developed a vast ecosystem around it so that it functions and so that it works. Trying to suddenly sort of build that. Funnily enough, I went to, it always reminds me of a trip to Ghana I had in the late 90s to look at their stock market. And you go there, and essentially it was a World Bank project. The World Bank made a grant. They created this exchange, but no one uses it. In fact, most of the trading takes place through the Nigerian market, which is an organic structure, which has evolved over the last,
I so part of my life.
This is the problem
Sometimes
of grafting these
new
things
wine
in.
needs
How
new
do you-
wineskins.
Right.
So we do need something new, but unfortunately what we've done is we've taken a new set of ideas like sustainability and tried to impose them on a market, a 300-year-old market, which don't like it very much.
Right. Okay.
And that's the issue with it, is that you're always going to get this clash of culture, between traditional, the way investors do things traditionally, and we actually have to redesign finance and redesign the economy. And to try and expect an old exchange like the London Stock Exchange to redesign itself for the 21st century in an era of resource constraints and the challenge to humanity, we need to think differently about how we do things.
So looking forward then, where do you think we'll be? Sustainable investment has, I mean, in the period I've been working in sustainable finance, it's absolutely soared in terms of level of interest, but you have some concerns about what's actually going on there. Is it on the right path? Does it need radical change? What does the future hold in your view?
I mean, I've never shied from saying that my real interest is not just investing capital, but changing the nature of capitalism, and I am interested in new forms of sort of corporate organisation like B corporations and community interest companies, and how financial markets can work for them. And I'm also interested in one of the paradoxes of how finance works and capitalism works is that you suck all the money out of the edges of the world of society from if you look in the UK, from the north and invested through London to the other sides of the world to chase profit. And we're not recycling capital back into British communities, wherever it was. And I can't help but think, 40 years ago, Bristol had a stock market, Birmingham had a stock market. They all had their own markets, and capital was recycled back into local enterprises. As soon as we removed that local connection, a lot of local businesses weren't able to flourish, weren't able to find the risk capital that they needed. And so you get, like, London is the prosperous place in the UK, and everyone else is always trying to catch up. And I think that those of us working in responsible finance should be grown up enough to actually think, how can we deal with that? And not just sort of north-south from a UK context, but north-south in a global context, which is, how do we finance companies and enterprises where I used to work in sub-Saharan Africa?
That activity is there through, say, Abundance or FX. So these are the crowd funding platforms that try and build local capacity.
These are not going to be the core to what goes into someone's pension plan. And so I love FX, and I'm a huge fan of what Abundance has achieved. But we've got to do something that, I hate this word mainstream, but feels normal for how people invest. And that we could have built these alternative systems. And one company that has, or bank that has succeeded, is obviously Triodos Bank. It's been an amazing story ever since I knew it as Mercury Provident. Down in Sussex, and it's become an astonishing success. But how can we do that scale of success, but for stock markets and bond markets?
Mark, we want to really look at this internationally and think globally. And you've already talked about social stock exchanges. Do you think that's a model that could be applied in other parts of the world? I mean, for example, sub-Saharan Africa has very few public markets. There's the Johannesburg Exchange, and South Africa has a strong capital market, but other parts of Africa don't have that. And then thinking about Asia, we're seeing centralisation in the way that that's happened here in the UK, and you've spoken very eloquently about that. What are the opportunities there around building that?
Yeah, thanks, John. So my vision with the social stock exchange idea was to bring companies that could be based in the global south, could be in Ghana or in Kenya or wherever and bring them to list in an international market like London to cycle capital from the global north to the global south, and that, if it succeeded, was part of my original vision. There are two social stock exchanges which have kind of got a long way towards that, actually, but one is called the Social Impact Exchange in Singapore, that takes Asian companies, private, and is using capital to attract investors to back these growth companies in Asia. And the other is actually a phenomenon in India, also called the Indian Social Stock Exchange. But instead of it being for private companies, it's actually for companies and investors to recycle capital back into society. It's almost like a philanthropy exchange. And you know, in the dilemma in all of this, we've grown up in the UK with a free healthcare system, with a free educational system, and we've got great roads and so on. Many parts of the world, healthcare isn't free, education isn't free, and they're dependent on philanthropy and they're dependent on other ways of doing things. And so in the case of India, you know, they've created an exchange that tries to address that. And it's a kind of a hybrid between sort of state capital and private capital and philanthropy. But what it just shows you is, you know, is we've got to think smart about how we solve these huge problems. And in the middle of it, you know, finance runs all the way through it as a vein. And we can use finance to do good things, or we can use it, as we know, to do really bad things. And we've got to experiment and explore innovative ways to face up to some of the world's most challenging problems.